What if you could spot the next Apple or the next Tesla before it skyrocketed? Or what if you could avoid a total stock market disaster or pick the next Bitcoin? Hey everyone, I'm Crypto Billy. Welcome to Billy Go Tales and our motivational mindset series. Picking the right stock isn't about luck. It's about knowing exactly what to look for. In the next 8 minutes, I'm going to share the 5 best ways to evaluate a company's stock like a pro so you can invest with confidence. So let's dive into this. Well, before we dive in, let's first talk about why. Buying a stock means owning a piece of a company, but not every company is a winner. Some are like shiny cars with no engine, great on the outside, but they will leave you stranded. Evaluating a stock helps you separate the champs from the flops so your money grows instead of vanishing. These 5 methods are what top investors use to make smart decisions every day. They're simple, they're powerful, and you can start using them today. No finance degree required, none needed. Here's how we do it. First up, you got to know and check the price to earnings ratio. You hear it on CNBC, the PE ratio, price to earnings ratio. This tells you if a stock is overpriced or if it's a bargain. It's like checking the price tag on a pizza. 20 bucks for a slice is nuts. It's absolutely nuts. Or is it really good? The PE divides a company's stock price by its earnings per every share. So divides the company's stock price by its earnings per every share. A high PE, like 50, it means investors expect big growth, like with these tech giants. A low PE, like 10, might mean it's undervalued or it's struggling. So when you know that, just at a glance, when somebody says, oh, it's got a PE of 50, in your mind, you can know that that thing is growing. It's high value growing. And when they say, oh, it's at a 10, it could mean that it's undervalued or it could mean that it's struggling. And what's so cool, you can compare a PE to the industry average on sites like Yahoo Finance. If it's way higher, ask yourself why. Why is this stock I'm looking at way higher than the industry average? Is it growth potential hype? You don't know, right? You have to dig in. This is your starting point, knowing the PE and knowing what a good PE is. Number 2, analyze revenue and profit growth. Sounds complicated. It's not. Just look at the revenue and look at the profit growth. Revenue is the money a company makes. Profit is what's left after expenses. Think of it like a lemonade stand. Selling $100 worth of lemonade is great. But if lemons cost you $90, you're barely profiting. Check the company's last 3 to 5 years of their financials. And it's always available on their investor relations page or on their SEC filings. You can get this information about anywhere nowadays. Steady revenue growth and rising profits signal a very healthy business. So that's basically saying sales are good, sales are growing, and profit is growing and getting better and better. And also watch for red flags like revenue growing, so sales growing, but profit is shrinking. That could mean rising costs or bad management. Those are the 2 big ones. Number 3, assess a company's debt ratios. Check the company's debt. Too much debt is like maxing out your credit card. You might look rich, but you're one missed payment from big trouble. Look at the debt to equity ratio. It's found on many financial sites like Morningstar. It compares what the company owes to what it owns. A ratio below 1 is usually really good. Above 2 is risky, even for smaller firms. So when you see the debt to equity ratio below 1, it's listed there. It usually means good. So at a glance, you can see 0.67, it's below 1. That's good. You just can know that. And that helps you in a second, in a flash, assess the company's debt to equity. Low debt means the company can weather tough times like a recession without collapsing. So think stability. Number 4, does the company have a competitive advantage, or what we like to term a moat? A moat is what keeps rivals at bay, like Apple's brand loyalty or Amazon's massive logistics network. Ask, what makes this company special? Is it patents? Is it unique tech? A cult-like customer base? And you think about that when you think of Apple. Can you find clues in their annual report or their news articles that suggest how they're different, their unique selling proposition that makes them very, very different? They have a moat around them, a moat around a castle. A strong moat means they'll stay ahead, making their stock more reliable for the long term. So, no moat, competitors can eat their lunch and their stock could tank. Look for companies that stand out and have a moat. And then number 5, finally the 5th item, check the management team. A great company with bad leaders is like a sports car with a terrible driver. Crashes are likely. So look at the CEO's track record. Have they grown the company? Made smart acquisitions? Check their bio on the company website or even on LinkedIn. Also, read investor calls or watch X for chatter about leadership scandals. Good management aligns with shareholders, not just their own wallets. Trustworthy leaders make stocks a lot safer, so do not skip that step. It's very important. So, how do you use all these? Well, start with one stock you're curious about. Pull its PE ratio up, take a look at it, check its revenue and profit trends, dig into its debt, evaluate its moat, and check out and research its management team. You don't need to be perfect. You just need to be consistent. Use free tools that are out there. Free tools like Yahoo Finance, Google Finance, or even the company's investor page. Over time, you'll spot patterns and you will build confidence. The goal isn't to predict the future. It's to stack the odds in your favor. And I'm telling you, these 5 methods are like a treasure map to smarter investing. So, why does it all matter? Because investing isn't and shouldn't be gambling. It's about making informed choices to grow your wealth. These 5 ways to evaluate a stock gives you the power to spot winners, avoid losers, and build a big, nice portfolio that you're proud of. So whether you're saving for a house, retirement, or just some extra cash, this is your ticket to financial freedom. And how does it relate to crypto? After I gave you these 5 techniques, you should all now be able to better understand why Crypto Billy is a big fan of Cardano. Think these 5 things in the crypto space and Cardano and figure out why Crypto Billy is such a fan applying these 5 techniques to and of Cardano. All right, guys, have a great day. We'll see you tomorrow. Thanks for stopping in to Billy Goat Tales.
You can be tough, you can be hard. If you are not a giver, here's my card. There is only one way to win, one way to be well through loving and giving. There is nothing else.